Recent statistics demonstrate that this is the most challenging economic situation many well-known shops have ever experienced. Retail sales merely dropped once again last month as inflation kept rising and drastically reduced purchasing power. Number 1. Staples. This renowned office superstore's collapse began over 10 years ago when it closed 225 outlets. Hundreds of millions of dollars in income were lost as a result of the closings. The corporation was in serious financial trouble when the pandemic struck in early 2020, owing $5.325 billion in debt, while only making $1.514 billion in revenue. Since that time, particularly in light of the increase in remote working, the office supply merchant has never fully recovered. It is still unclear if the brand would survive the present recession due to its current obligations, but it wouldn't be shocking if the worst-case scenario came true. Number 2. David's Bridal. After operating for more than 7 years, David's Bridal filed for bankruptcy in 2023, and we might have to bid this well-known manufacturer of wedding attire farewell. The company's fall was mostly attributed in April by management to inflationary pressures and decades of changes in the wedding business. The corporation cut almost 9,000 workers, and it is currently working to reorganize its debt. However, creditors don't appear overly hopeful about the chain's future. CEO James Markham stated that the chain of stores would be totally liquidated by the end of 2023 if a buyer didn't intervene to preserve the firm. Number 3. Walgreens. In 2023, it appears like Walgreens' 122-year-old empire is coming apart due to mounting losses. The nationwide drugstore business, which has close to 8,700 locations, announced 450 shop closings for the year. The company's shares dropped to a low of 28.64 in March, marking their lowest point in more than 11 years. The corporation might file for bankruptcy, owing to its $13 billion debt burden if it is unable to settle its debts with its creditors in the next few months. Today, according to its most recent financial report, Walgreens only has $1.84 billion in cash. Number 4. Rite Aid. Rite Aid, a rival, has also been dealing with more difficulties lately. The truth is that the firm has been struggling for years, and Rite Aid is fading into obscurity as a result of competitors having considerably larger customer bases and producing substantially more cash flow. The organization's potential for profitability declines as it gets smaller. Foot traffic has been steadily declining over the past 3 years, and the stock is presently down 41% from this time last year and 65% from the previous year. During this slump, the chain's limited ability to turn things around might hasten its downfall. Number 5. Victoria's Secret. Even after undergoing a significant makeover after declaring bankruptcy in 2020, the clothing retailer's financial fortunes haven't much improved. After reporting a 9% drop in sales in January, retailers saw a further 7% drop in sales in the second quarter, as American shoppers looking to save costs were turned off by expensive goods. In this fiercely competitive industry, Victoria's Secret items are becoming less and less desirable due to the growth of independent and internet firms. In the last 3 years, almost 300 locations have closed permanently, and at least another 50 are expected to do the same in 2023. Number 6. Foot Locker. Foot Locker, a retailer of shoes, is on the bankruptcy watch list as business performance continues to lag behind declining foot traffic. The business announced in March that it would shutter 125 stores run by its subsidiary Champs Sports, in addition to 400 U.S. retail locations. The retailer's overall sales for the first quarter of 2023 were $1.92 billion, down from $2.17 billion in the same period last year. As a result, it is anticipated that the company's annual sales will plummet by a startling 10%. The recent quarter's 11.4% decline in sales also caused Foot Locker's shares to plunge by 27% in a single day. The brand's future is looking bleak, and in order to survive the crisis, it urgently requires a fresh reorganization strategy. Number 7. Home Depot. The American home improvement retailer with the greatest market share is concerned about how a weakening economy would affect its operations. The firm just released its disappointing quarterly report as a result of a sharp decline in customer expenditure on home improvement projects. After consumers delayed their spending, the store reported weak sales for the first quarter and revised down its expectations for the year. During its most recent quarter, Home Depot's sales at shops operating for at least a year declined by 4.5%, and its revenue dropped by 6.4% from the same period a year earlier. Comparing the quarter to the prior year, total sales. Number 8. Kohls. It may just be Kohls' fault for his inability to get a break. The department store company said it now anticipates four-year sales to decrease by 7% compared to a year earlier after raising prices 4 times in the previous 3 years. The firm attributes the failure of consumers to spend more money at its stores to ongoing inflation, particularly among middle-class customers. Additionally, for the quarter that concluded on June 30th, the firm recorded a decline in revenue and earnings. Deanne Campbell, chief strategy officer at the consulting firm Rite Aid, claimed that Kohls has been drifting off course for a very long time. Number 9. Marshalls. Marshalls, a well-known chain of discount retailers, has also seen shop closures and pricing increases recently. The corporation is currently closing hundreds of its stores, with closures taking place in Pennsylvania and Minnesota this month. Even after launching a website in 2022, the company's revenues have remained flat or even declined over the last year, since it is unable to set itself apart from other bargain stores in the same industry. The company blamed the sluggish underlying sales on the hazy macroeconomic environment. Executives also expressed concern that full-year earnings would fall short of forecasts, which caused shares to decline 15% and undo all of their gains from 2021. Number 10. 7-Eleven. Customers may not expect the chain to fall so quickly as a result of the ongoing conflict between 7-Eleven and its franchisees. We have been at odds with 7's franchisees for a long time. One of the disagreements is 7-Eleven's demand that outlets be open 24 hours a day. Franchisees have expressed their dissatisfaction over how difficult it has been to find employees for the evening shift. Franchisees claim in a lawsuit against the firm that they are merely glorified shop managers who should be paid more than the minimum wage to run the stores. Number 11. Old Navy. Retail analysts claim that the majority of the 1,800 job reductions reported by parent firm Gap so far this year were caused by Old Navy's problems. Sales at the brand's locations open for at least a year are down 7%, while first quarter sales declined 6% compared to the same period last year. The firm frequently uses profit-eroding discounts to move inventory and has a history of being behind on product launches and fashion trends. Buyers won't pay full price for products. That is a surefire recipe for failure that won't let Old Navy survive for another year. Number 12. Urban Outfitters. Due to inflation's effects on its younger demographic customer base, the Urban Outfitters business is currently experiencing severe difficulties. Over the past year, U.S. management has committed grave operational mistakes. According to analysts, the chain saw a 9% decline in brick-and-mortar retail sales in the first quarter, with customers blaming increased pricing as the primary factor. Since the fourth quarter of last year, the stock's value has decreased by 32%. The situation is still hazy, and if things keep going the way they are, hundreds of stores might close by the end of 2023. Number 13. Men's Warehouse. The company's struggle to remain relevant in the men's clothing market appears never-ending. Men's Warehouse has struggled to regain its reputation as one of the top destinations for suits and men's clothes since a decline in the middle of the previous decade. The brand has suffered as a result of its inability to keep up with the changes and connect with the younger generation. The suit industry may never regain its previous prominence as more and more employers let employees work remotely or in casual attire. Number 14. Bed Bath & Beyond. Before the economic crisis, Bed Bath & Beyond was already in decline, but the start of the recession has only made its financial problems worse. Investors are growing impatient with the chain after the firm experienced a 22% decline in revenues in January, its worst loss in years. In the past year, the stock has fallen by 35%, and its debts have received a junk bond rating. The firm has suffered from high inflation, the existence of Amazon and other online retailers, as well as falling shop foot traffic and aging store sites. The brand is presently on a multi-year turnaround strategy, but given all the challenging circumstances, success is not certain. Number 15, Dillards. It seems as though Dillard's department store chain is doomed. It may be past the point of no return for Dillard's, given its protracted struggle to produce a profit. The firm recorded a 23% decline in revenue in January, after showing dropping sales for most of the year. The firm said that a 16% fall in the number of stores it runs and a 10% decrease in store days contributed to fewer sales of items. As Dillard's financial situation continues to deteriorate, analysts forecast further store closures for the retailer in the near future. Which of them do you think will succeed? Do let us know and subscribe to our channel.